Hello, everyone. Welcome to my channel, where I expose the hidden secrets of money and taxes that the wealthy don't want you to know. Today, I'm going to tell you how the wealthy use tax loopholes to avoid paying their fair share of taxes, and how you can use them too, if you know how. You might think that taxes are unavoidable, and that everyone has to pay them, according to the law. But I'm here to tell you that taxes are avoidable, and that some people don't have to pay them, or pay very little, by using the law. These people are the wealthy, and the powerful, and the influential, who have access to the best tax advisors, and the best tax strategies, and the best tax loopholes, that the average person doesn't have, or doesn't know, or doesn't use. And these tax loopholes are the legal ways, and the legal means, and the legal methods, that the wealthy use to reduce their taxable income, and their tax liability, and their tax rate, and their tax bill, to the minimum, or to zero, or even to negative. I'm here to reveal these tax loopholes to you, for free, because I want you to know the truth, and be free too. But don't just take my word for it, see it for yourself, and judge for yourself. I guarantee you, you won't regret it. Once you know the truth, you can't unknow it. Are you ready to hear the secrets? Let's get started. The first tax loophole that the wealthy don't want you to know is the capital gains tax rate. Yes, the capital gains tax rate, the lower tax rate that applies to the profits that you make from selling an asset, such as a stock, or a bond, or a property, or a business, that you have held for more than a year. The capital gains tax rate is lower than the ordinary income tax rate, which applies to the income that you earn from working, or from interest, or from dividends, or from other sources. The ordinary income tax rate can be as high as 37%, depending on your income level, and your filing status, and your deductions, and your credits. But the capital gains tax rate can be as low as 0%, or 15%, or 20%, depending on your income level, and your filing status, and your deductions, and your credits. That's a big difference, and a big advantage, for the wealthy, who make most of their money from capital gains, and not from ordinary income. And that's why the wealthy don't want you to know about the capital gains tax rate, because they want to keep it low, and keep it secret, and keep it for themselves. But did you know that the capital gains tax rate is not fixed, but flexible, and that you can manipulate it, and lower it, and even eliminate it, by using some tricks, and techniques, and tactics? And did you know that the capital gains tax rate is not fair, but biased, and that it favors the wealthy, and hurts the poor, and widens the gap between the rich and the poor? Did you know that the capital gains tax rate is not efficient, but wasteful, and that it distorts the market, and encourages speculation, and discourages investment, and reduces growth, and innovation, and productivity? These are the secrets that I'm going to tell you, one by one. You see, the capital gains tax rate depends on your taxable income, and your taxable income depends on your gross income, minus your deductions, and your credits. And your gross income, and your deductions, and your credits, are not fixed, but variable, and you can change them, and adjust them, and optimize them, to your benefit, and to your advantage. Of course you can do it in many ways, and many times, and many occasions. And I'm going to give you some examples, of how you can do it. One example, is how you can time your capital gains, and your capital losses, to offset each other. You see, when you sell an asset, for more than you paid for it, you have a capital gain, and you have to pay tax on it, at the capital gains tax rate. But when you sell an asset, for less than you paid for it, you have a capital loss, and you can use it to reduce your tax on your capital gains, or on your ordinary income, or on both. And this is called tax loss harvesting, and it is a strategy that the wealthy use, to lower their taxable income, and their tax liability, and their tax rate, and their tax bill, by selling their losing assets, and buying similar assets, to maintain their portfolio, and their returns, and their risk, and their diversification. They do it at the end of the year, or at the end of the quarter, or at the end of the month, or whenever they have a capital gain, or a capital loss, that they want to use, or to avoid, or to defer, or to transfer, to their benefit, and to their advantage. And this is the first trick, that I'm going to tell you, about the capital gains tax rate. Another example, is how you can use tax-advantaged accounts, and vehicles, to defer, or avoid, or reduce, your capital gains tax. You see, when you invest in a regular account, or vehicle, such as a brokerage account, or a mutual fund, or an exchange-traded fund, or a real estate investment trust, you have to pay tax on your capital gains, every year, as you realize them, or as they are distributed to you, by the account, or the vehicle. This reduces your returns, and your compounding, and your growth, and your wealth, over time. But when you invest in a tax-advantaged account, or vehicle, such as a retirement account, or a health savings account, or a 529 plan, or a charitable trust, you don't have to pay tax on your capital gains every year, as you realize them, or as they are distributed to you by the account or the vehicle. You can defer your tax until you withdraw your money from the account or the vehicle, or you can avoid your tax altogether if you meet certain conditions or requirements or rules for the account or the vehicle. And this increases your returns and your compounding and your growth and your wealth over time. And these are just some examples of how you can manipulate the capital gains tax rate and lower it, and even eliminate it, by using some tricks and techniques and tactics. There are many more that I could tell you, but I don't have time or space to do it. But you get the idea, and you get the point, and you get the secret. That's the first secret that I'm going to tell you about the tax loopholes that the wealthy don't want you to know. The second tax loophole that the wealthy don't want you to know is the estate tax exemption. Yes, the estate tax exemption, the amount of money that you can leave to your heirs without paying any federal estate tax, or inheritance tax, or death tax, as some people call it. The estate tax is a tax that applies to the transfer of property, or wealth, or assets, from a deceased person to their beneficiaries, or heirs, or legatees, or devisors, or whatever you want to call them. The estate tax is a progressive tax, which means that the higher the value of the estate, the higher the tax rate, and the higher the tax bill. The estate tax can be as high as 40%, depending on the value of the estate, and the year of death, and the law in effect at the time. And that's a big chunk, and a big bite, and a big burden for the heirs, who have to pay the tax, or sell the assets, or borrow the money to pay the tax within 9 months of the death of the deceased. That's why the wealthy don't want you to know about the estate tax exemption, because they want to keep it high, and keep it secret, and keep it for themselves. But did you know that the estate tax exemption is not fixed, but variable, and that you can increase it, and maximize it, and even double it, by using some strategies, and plans, and tools? Did you know that the estate tax exemption is not fair, but biased, and that it favors the wealthy, and hurts the poor, and widens the gap between the rich and the poor? And did you know that the estate tax exemption is not efficient, but wasteful, and that it distorts the market, and discourages work, and encourages waste, and reduces growth, and innovation, and productivity? These are the secrets that I'm going to tell you, one by one. The first secret that I'm going to tell you is that the estate tax exemption is not fixed, but variable, and that you can increase it, and maximize it, and even double it, by using some strategies, and plans, and tools. You see, the estate tax exemption is not a fixed amount that applies to everyone, and every estate, and every year. The estate tax exemption is a variable amount that depends on the law, and the inflation, and the election, and the situation, and the decision of the government, and the Congress, and the President, and the courts, and the IRS, and the taxpayers, and the estate planners, and the estate owners, and the estate heirs. This means that the estate tax exemption can change, and fluctuate, and increase, and decrease, and expire, and renew, and extend, and limit, and expand, and contract, and vary, from year to year, and from estate to estate, and from person to person. And this means that you can influence, and manipulate, and optimize, and maximize, and even double, your estate tax exemption, by using some strategies, and plans, and tools, that the wealthy use, to reduce their estate tax, and to increase their estate value, and to preserve their estate legacy, and to protect their estate heirs. And I'm going to give you some examples of how you can do it. One example is how you can use the portability rule to transfer your unused estate tax exemption to your surviving spouse. You see, the estate tax exemption is not only a personal exemption that applies to your own estate, and your own assets, and your own wealth when you die. The estate tax exemption is also a marital exemption that applies to your spouse's estate, and your spouse's assets, and your spouse's wealth when your spouse dies. And this means that you can transfer your unused estate tax exemption to your surviving spouse, and add it to your spouse's own estate tax exemption, and create a larger estate tax exemption for your spouse, and for your heirs, and for your estate. And this is called the portability rule, and it is a rule that the wealthy use to double their estate tax exemption, and to avoid paying any estate tax, or paying very little estate tax, on the combined estates, and on the combined wealth, and on the combined assets. And they do it by filing a simple form, called the Form 706, or the United States estate and generation skipping transfer tax return within 9 months of the death of the first spouse, and by electing the deceased spousal unused exclusion amount, or the DSUEA, which is the amount of the estate tax exemption that the first spouse did not use, or did not need, or did not want to use on their own estate, and that they want to transfer, or to port, or to give to their surviving spouse, and to their surviving spouse's estate tax exemption, and to their surviving spouse's estate. Another example is how you can use trusts and gifts and charities to remove assets from your estate and from your estate tax. You see, when you die, your estate is valued and taxed based on the fair market value of all the assets that you own, or control, or have an interest in, at the time of your death, or at the time of the distribution of your estate to your heirs. This includes not only the assets that you have in your name, or in your possession, or in your account, or in your safe, or in your vault, or in your home, or in your business, or in your property, or in your portfolio, or in your collection, or in your whatever. This also includes the assets that you have in someone else's name, or in someone else's possession, or in someone else's account, or in someone else's whatever. And this means that you can remove assets from your estate and from your estate tax by transferring them, or giving them, or donating them to someone else, or to something else, before you die, or after you die, and by using trusts and gifts and charities to do it. These are the tools that the wealthy use to reduce their estate value and their estate tax, and to increase their estate benefit and their estate impact, and to preserve their estate assets and their estate heirs, and to protect their estate interests and their estate causes. And they do it by creating trusts, such as revocable trusts, or irrevocable trusts, or living trusts, or testamentary trusts, or anything that you can think of. They do it by making gifts, such as annual gifts, or lifetime gifts, or exclusion gifts, or exemption gifts, or gifts of anything that you can give, or that your recipient can receive, or that your gift tax whatever can whatever. They do it by donating to charities, such as public charities, or private charities, or foundations, or organizations, or anything asterisk that you can donate to, or that your charity can accept. And these are just some examples of how you can use trusts and gifts and charities to remove assets from your estate and from your estate tax by using some strategies and plans and tools. And there are many more that I could tell you, but I don't have time or space to do it. But you get the idea, and you get the point, and you get the secret. And that's the second secret that I'm going to tell you about the tax loopholes that the wealthy don't want you to know. And I could go on and tell you more secrets about the tax loopholes that the wealthy don't want you to know, such as the income tax loopholes, and the corporate tax loopholes, and the international tax loopholes, and more. But I don't want to make this video too long, or too boring, or too overwhelming. So I'm going to stop here, and leave you with these two secrets, that I hope you found interesting, and informative, and eye-opening. And I hope you learned something new, and valuable, and useful, from this video. And I hope you enjoyed it, and liked it, and subscribe to my channel, for more videos like this. And I hope you share it, and comment on it, and give me your feedback, and your opinion, and your questions, on this video. And I hope you join me, next time, when I reveal more secrets behind the money and taxes, and the wealthy. With that said, thanks for watching, and until next time.